Okay, now let's continue our discussion of the advanced evaluation methods. So we talk about three different methods: the Wac method, the APV method, the FTE method. Remember, in the beginning of this chapter, we basically made two basic assumptions. The first is we assume the firm maintains a constant debt value ratio. And then the second piece of assumption is we assume there are no other complications, such as there are no financing costs, there are no agency costs. And then in the last lecture, we basically relaxed the first assumption, right? We discussed in more detail this APV method. That is, we relaxed the assumption that firm always maintains a constant debt value ratio. And in last lecture, we discussed three different cases, right? So we talked about the two different cases. So the first was the constant interest coverage ratio. And then the second was the firm uses a predetermined debt levels. And today we relax this second assumption. Today we're gonna talk about the following complications: when there are financing costs, and when there is mispricing, and then when there are financial distress costs. So first, financing costs. Financing costs are pretty easy to understand conceptually. It basically says that if the firm tries to obtain financing by either using debt or using equity or borrowing from a bank, then there is always some transaction cost, right? For example, if the firm wants to finance its investment with some, let's say, with equity. In this case, the bank underwriting this security issuance will charge a fee, and then the firm has to pay the fee, right? So the fee charged by the bank is a transaction fee. It is a type of financing costs. Okay, so you can see that when you're evaluating your project, more realistically, you want to consider these fees. And when you're doing your calculation, you will basically want to deduct these fees from your project's NPV calculation. So let's first see some data. This table is basically about transaction costs for different types of securities. So you can see that now we have bank loans, and we have debt, and we have equity. And roughly speaking, you can see that bank loans and debt, they have the similar level of underwriting fees. It's about 2%. And issuing equity is much more expensive, right? Depending on what kind of equity you're trying to issue. You could go from about 5% to 8%. So here you can see that depending on the type of debt, you could have different underwriting fees. For example, if you're doing investment grade, that is high quality debt. Remember, if your debt has a rating of BBB and above, then this is considered to be a investment grade corporate bond, and your fee would be 1 to 2%. And then if the firm is issuing the corporate bond which has a debt rating below BBB, then this is non-investment grade bond or junk bond. So in this case, the underwriting fees would be 2 to 3%. Okay, equity, we have two cases. The first is IPO, The second is SEO. IPO basically means the first time the firm files for going public, right? It gets listed in a certain stock exchange. In this case, the underwriting fee is about 8 to 9%. And then we also have SEO, which is seasoned equity offering. It basically means the firm is already a public firm. That is, the firm has done its IPO. And now the firm wants to obtain additional financing by issuing additional equity. This is called seasoned equity offering. And the cost is about 5 to 6%. Anyway, what you can see here is it's actually pretty expensive, right? Especially for equity. It will basically reduce your investment return by 8 to 9% if you're doing a IPO. And if you're doing a SEO, then the return of your investment will be reduced by this 5 to 6% underwriting fees. Okay, the second realistic case we want to consider is security mispricing. So if you recall Corporate Finance 2, we discussed security mispricing. So basically, the statement is like this. It basically says that due to the asymmetric information between the firm and the investors, generally, equity will be underpriced. And so firm will actually generally want to prefer to first use its retained cash, then the firm will use debt, and firm will use equity as the last resort. The reason is because equity is the most underpriced compared with debt. Of course, that was some theory about how the firm chooses its capital structure. Here, our main focus is how should we evaluate the project, or how should we do the valuation if there is security mispricing. This is actually pretty simple, right? What you will do is you will just calculate the mispricing cost, and then you will deduct this cost from your NPV calculation, right? So, for example, if you're doing equity financing and you know that equity is underpriced, which means if you want to sell $10, then the shareholders will only want to give you $9. So in this case, you can see that there is a $1 underpricing. Then when you're calculating the NPV of your project, you will want to deduct this $1 underpricing cost from your NPV calculation, right? So it's pretty easy. Okay, now let's see this example here. So this is NIGARD or NIGARD. I think it's NIGARD. So NIGARD International is borrowing $100 million to make some investment. And given investors' uncertainty regarding this investment, NIGARD will pay a 6% interest rate on this loan. And the firm believes that the actual risk of this project is actually quite low. So the fair rate, the appropriate rate on the bank loan is actually 5%. So you can see that in the case of using debt to obtain financing, there is underpricing here, right? Because the fair interest rate is 5%, but investors, they demand a 6% interest rate. Suppose the loan will be for 5 years, and then the principal will be repaid in the 5th year. If NIGARD marginal tax rate is if NIGARD has a marginal corporate tax rate of 40%, what is the net effect of the loan on the value of the expansion? So clearly, this is about the this is about valuing this loan. That is, we're doing a valuation exercise here, right? In some sense, we're trying to find out what is the NPV of obtaining this loan. Here, the word NPV is not super appropriate because generally when you talk about NPV, you will want to talk about some project, not about some loan. But you will see why I want to use the word NPV here. So now let's start to answer this question. As I said, you want to do some valuation on this loan. And obviously, in any evaluation, you will think about two things, right? Cash flows and the discount factor. So let's first draw out the timeline. Okay, let me draw a larger timeline. So this is a 5-year investment, and the firm borrowed $100 million. So you can see that the face value of this debt is $100 million, right? And the interest rate is 6%. So let's assume the interest payment will be made at the end of the year. So basically you can see that now we can find the cash flow of this bank loan. So basically you can see that at the end of the first year, the firm has to pay the interest rate on $100 million, right? So the cash flow here is $6 million. And the firm will continue to pay these interest payments at end of each year. And for the 5th year, the firm will have to pay $100 million face value, right? So at the end of the 5th year, the cash flow would be 6 plus 100. Now, if you want to do the valuation exercise here, you can pretty much discount these cash flows with the debt cost of capital, and you will find out what is the present value of these cash flows. However, in this corporate finance context, you have to think about interest tax shield, right? So basically, you can see that if the firm is paying interest payment each year, then this interest payment will generate interest tax shield. And this interest tax shield obviously will benefit this firm. So if the firm pays $6 million of interest payment, what is the size of the interest tax shield? We have learned if you use the tax rate times the interest payment, then you will get the interest tax shield. So if the interest payment is $6 million and tax rate is 40%, so we can see that the interest tax shield will be 2.4 at each year. Note that there is no interest tax shield from paying out the loan's face value $100 million. So at the 5th year, you will only have $2.4 million of interest tax shield. Okay, now if we note that for these interest payment, there are cash outflows, and for interest tax shield, clearly we should use plus sign here. And now, after considering both the interest payment and the interest tax shield, you can find out the total cash flow each year, right? So basically you can see that for the first year, the total cash flow would be, I think it's 3.6. Right? Oh, I forgot I have to minus this face value of $100 million. So now you will discount this cash flow with the appropriate debt cost of capital. And now to discount these cash flows, you will want to use the 5% discount rate. So basically you can see that what you will do is the net effect of the loan will be given by this. Oh, we have to think on day 0, you have $100 million. So you raise $100 million on day 0, right, from the debt. So don't forget this part. And then you will pay out these cash flows. Of course, I should use squared. And then you will continue to do this. And at the, you know what? I will just write all these terms. And then the last term would be, let me see, minus 103.6 divided by 1 plus 5% with a number of 5 here. So you will, if you use your calculator, then you will find out the value here is 8.66. So basically the net effect of this loan is $8.66 million, right? So you can see that this is pretty much like calculating the NPV of a project. Okay, so let me summarize, right? What is the caveat here? I think there are 2 caveats. First, you cannot only calculate, or you cannot only find out the firm's interest payments. You have to also think about the interest tax shields. That's the first caveat. The second caveat is you should use the fair interest rate of 5% as the discount factor. You should not discount these cash flows using 6% interest rate. 6% interest rate basically is only used for calculating your interest payment. And when you discount it, you will use the 5% fair interest rate, right? Okay, let's look at the solution provided by the lecture note. It's slightly different and it's more complicated. However, it has this benefit to tell you what is the NPV of your loan and what is the present value of your interest tax shield. So you can see that the problem discusses 2 cases. The first case is the fair loan case. That is, we assume the firm is actually paying 5% interest rate. So the second case is the case we just discussed about. You can see that the firm gets $100 million and the firm pays out $6 million of interest payment at each period. And last period, $6 million and $100 million of face value. And then there is this interest tax shield, right? So basically you can see that the second case essentially tells you that what is the cash flow you can get from the loan and what is the interest tax shield you can get. And having these two streams of cash flows, we can get the NPV of this debt, right? So how do you get minus 4.33? Well, to get this, you would discount these cash flows at 5% discount factor. And this will give you $4.33 million. And you can see that this is a negative number, right? This is a negative number. The reason is because there is underpricing in the debt. So the NPV of this debt is essentially a negative number. And then we also have this interest tax shield, right? So what you will do is you will discount these interest tax shields. And this will give you the present value of the interest tax shield. Again, you will discount these cash flows at 5% rate. Oh, I think I made a mistake. So in the second case, in this case, so if the NPV of the loan is minus 4.33 and the present value of the interest tax shield is 10.39, then I guess if you use calculator to make the calculation here, you can see that it should be equal to 6.06. Okay, and the textbook also give you the additional case if the firm is using a fair loan, right? So if the debt is fair, then in this case, the firm will actually only pay 5% interest rate, right? So you have these interest rate payments. And then you would discount these cash flows at 5% interest rate. So you can see that the net present value of the debt should be zero because this is a fair debt, right? There is no underpricing. Of course, the net present value should be zero. And then we have this interest tax shield. So you can see that now the interest tax shield would be 8.66. And if you compare these two cases, right? So this is the case of no underpricing in debt. And here, the second case, there is underpricing. And you can see that if there is no underpricing, then the NPV of the debt is zero. And the present value of the interest tax shield is actually smaller compared with the present value of the interest tax shield when there is underpricing. This is easy to understand, right? Because if there is underpricing, then the firm will pay higher interest payment. This will generate larger interest tax shield. However, you can see that in the end, the firm will suffer because the benefit from the larger interest tax shield is smaller compared with the cost from the underpricing. You can see that the underpricing here is $4.33 million, right? And the underpricing outweighs the benefit of larger interest tax shield. So that's why in the end, the firm will suffer. Okay. Right, so this is the final answer, 6.06. And you can see that this is smaller than $8.66 million. And in the end, the firm suffers. Okay, the third case, that is financial distress cost. The title is financial distress cost. Sorry, the title is financial distress and agency cost, but we will mainly focus on financial distress cost. Again, this is related to corporate finance too. Financial distress basically means if the firm has too much debt, then the firm could potentially have difficult in meeting its debt obligations, or the firm could face the risk of bankruptcy. So in this case, there will be some financial distress cost. And agency cost is mainly connected with asymmetric information in the firm. And we also discussed this in corporate finance too. So I think I will only focus on financial distress cost because this is the major focus in this lecture note. So if you think about the financial distress cost, then obviously this will affect your valuation, right? First, clearly, financial distress cost is a cost. It will basically reduce your project's future cash flows, right? And then, because of financial distress, the firm will also become riskier. In this sense, it basically means the cost of capital for this firm will need to be adjusted. So, this basically means that to understand or to calculate the value or the NPV of a project when there is financial distress, we will have to reduce the projected cash flows by the amount of financial distress cost. And we also will have to increase the cost of capital due to the increased risk from financial distress. Now let's see this example here. So let's say your firm has no leverage and it generates free cash flows of $10 million per year in perpetuity. The firm's current cost of capital, unlevered cost of capital is 10%, and the tax rate is 35%. And you want to determine whether adding leverage will increase in the firm's value. Simulating the firm's future cash flows, you have estimated the likelihood and the cost of financial distress with different levels of permanent debt, and you have produced the following table. And the question is, what is the optimal level of permanent debt for the firm? So let's see what kind of data do we have here. So we first have this table, right? We have cash flows and we have unlevered cost of capital at different levels of debt. And then we also know that the firm is using permanent debt. And we also know that the firm has 35% corporate tax rate. Now we have to think about valuation, right? We basically want to find out at what level of debt the firm's value is the largest. Then we will use that level of debt as our optimal level of debt, right? So first, can we use Wac method? Because we know that Wac method is actually easy to calculate, right? So if you want to use Wac, you will have to adjust from unlevered cost of capital to the weighted average cost of capital, right? And we know that the formula of Wac says you will have this following adjustment. If you look at this formula, you can see that we actually don't have this E here, right? We don't know what is the value of equity. So maybe a more proper method we want to use is the adjusted present value, because you can see that we have the permanent debt here. And we have learned in the last class, when you have permanent debt, it's actually easy to compute the firm's levered value. Right? So this firm's levered value would be equal to VL equals VU plus corporate tax rate times debt level. And how do you calculate VU? Well, the problem says you have these cash flows. And we also have the unlevered cost of capital. So basically you can see that VU will be equal to 9.8 divided by 11%, right? Because this is essentially valuing a perpetuity. And then you can get numbers at all other debt levels. So I will just see the answer here. So you can see that the first row gives you the firm's unlevered value. And then you would use the 35% tax rate times the firm's debt level, which gives you the present value of the interest tax shield. And then you would add up these two components, right? The unlevered value and the present value of the interest tax shield. So this will give you the firm's levered value. And then you will look for the debt level, which maximizes your levered value. And you can see that this is the best level, right? Because at the debt level of 40, the firm's value is the highest with a number of $103.1 million. Okay, oops, what happened? Okay, so let's review this chapter. First, what are the three methods we can use to include the value of the tax shield in the capital budgeting decision? Well, three methods, right? The Wac method, the APV method, and the flow to equity, that is the FTE method. In what situation is the risk of a project likely to match that of an overall firm? This is really not a finance problem. It's just a common sense question, right? So if you're pursuing a typical or even old project, then you would see that this kind of typical project will have similar risk and similar cost of capital as the overall firm. For example, if you're a car firm, if you're General Motors, now if you want to build a new car model, then in this case, this project will have the similar risk to your overall firm. But now, if you as a car firm, right, General Motors wants to develop some, let's say, artificial intelligence capability. Now, in this case, the project will have will have a different risk compared with the overall firm. Now, third, describe the key steps in the Wac valuation method. First, you will calculate cash flows. Second, you will calculate Wac. Third, you will discount those cash flows with Wac. Fourth, describe the adjusted present value method. So basically, you will again think about three steps. First, you will calculate the unlevered value. What you will do is you will look for the firm's cash flows and discount those cash flows with the unlevered cost of capital. And then the second step, you will calculate the firm's interest tax shield. So to do this, you will have to calculate the firm's interest payment at each period. And to calculate its interest payment, you will have to find out the firm's debt capacity. at each period. And after getting the interest tax shield, you will discount those interest tax shields with correct, appropriate cost of capital. So this really depends on assumption, right? So if the firm is maintaining a target debt value ratio, then the level of debt will change with the firm's value. So in this case, the risk of the firm's debt is the same as the firm. So you will just use the unlevered cost of capital to discount these interest tax shields. But if we assume the firm has a fixed, predetermined debt levels in future, then basically in this case, debt level are predetermined. So the risk of the interest tax shield is just the same as the debt itself. So you will use the debt cost of capital to discount those interest tax shields. And then the third step is obvious. You will basically add the two numbers. That is, you will sum up the unlevered value and the present value of the interest tax shield. And this will give you the levered value. Okay, fifth, at what rate should we discount the interest tax shield? In the APV method, when the firm maintains a target leverage ratio, I just talked about this, right? You should use the unlevered cost of capital. Describe the key steps in the flow to equity method to valuing a levered investment. So you will have to find out or to calculate the free cash flow to equity holders. And then you will discount free cash flow to equity holders by the equity cost of capital. Seventh, why does the assumption that a firm maintains a constant debt equity ratio simplifies the flow to equity calculation? This is kind of obvious because if you have a constant debt equity ratio, then this means you will have a constant equity cost of capital. The reason is this. So if we assume the unlevered cost of capital and debt cost of capital are fixed or constant, then you can see that as long as the debt equity ratio is fixed, then the equity cost of capital will be fixed. So when you're valuing the firm, then you can use a single number to discount the firm's free cash flow to equity holders. Eighth, how do we estimate a project's unlevered cost of capital when the project's risk is different from that of a firm? So this one is pretty easy to understand, right? So basically, if the project has a different risk compared with the firm, what you have to do is you have to find the comparable firms. To be more specific, you will look for firms in the same line of business, and then you will try to find out those firms' unlevered cost of capital, and then you will use these comparable firms' unlevered cost of capital as your project's unlevered cost of capital. And I also emphasized that when you're doing this kind of comparable firm analysis, what you should do is you should really just copy other firms' unlevered cost of capital. You cannot use comparable firms' debt cost of capital as your project's debt cost of capital. And clearly, you also cannot use comparable firms' equity cost of capital as your project's equity cost of capital. Ninth, what is the appropriate discount rate for tax shields when the debt is fixed in advance? So basically, I have discussed this, right? Because if the debt levels are fixed, then you can see that there is no uncertainty on how much debt the firm will take in the future. So in this case, you should use the debt cost of capital to discount tax shields. 10th, how would financial distress and agency costs affect the capital budgeting process? Basically, you have to adjust two things. The first is because of the additional costs from financial distress and agency problems, you will have to deduct those costs from your project's cash flows. And then you will have to think about the project's risk will be increased because of the financial distress. So you will have to adjust your cost of capital in a proper way. Okay, that's for chapter 21. So now let's proceed to chapter 22. So chapter 22 is actually a very interesting chapter. It's a case study. So basically we will use what we have learned, those valuation techniques, and we will use these valuation techniques to look at a example and come up with solutions. Okay, so we can basically divide this chapter into two parts. I can call this as part 1, and this as part 2. So basically, we will look at a acquisition, and we will want to value the target firm. And then in part 1, we will use the very simple valuation technique. We will just use some comparables. That is, we will use some valuation ratios and compare these valuation ratios with comparable firms. And then in part 2, we will do a more formal analysis. We will come up with the business plan to improve the firm. And then we will build a financial model to estimate the cost of capital and to value the investment. And then we will do some sensitivity analysis. Sensitivity analysis is really a robust analysis. You will try to understand how your analysis will change if you change your assumptions. Okay, now let's think about the simple valuation technique, that is using valuation ratios. Okay, let's see the example here. We consider Idaho Corporation. So let's assume it's a private firm. And this firm is a designer and a manufacturer of specialty sports eyewear based in Chicago. Your job as a partner in PKK Investments is to evaluate purchasing the firm. So you can see that this is a private equity story here. So basically, you can consider this PKK Investment, right, as a private equity firm. And this private equity firm will want to make the acquisition. It will want to acquire this firm, Idaho Corporation. And as a result of some conversation with the firm's founder, you have estimates of the firm's income and the balance sheet information for the current fiscal year. So you can see that the current fiscal year is 2010. And as a partner, you have estimated these numbers. So we basically have income statement and balance sheet. Now, you believe a fair or a deal can be made if you offer to buy the firm Idaco with a acquisition price of $150 million. So this $150 million is the price to purchase Idaco's equity. And now you want to understand whether this is a reasonable price. As I said, to answer this question, we will use valuation ratios. And we will use these valuation ratios and compare them with other firms. So let's see what kind of ratios we want to use. So you can see that we want to use PE ratio, EV divided by sales ratio, EV and EBITDA ratio, and EBITDA sales ratio. So let's first talk about these ratios a little bit. First, what is PE ratio? What is P here? So P generally refers to stock price. E generally refers to EPS, that is earnings per share. But this is a private firm, so you don't really have a stock price. So here P refers to the price of equity, right? So the P is price of equity. What is the price of equity here? It's $150 million, right? What is E? Here the E refers to the firm's earnings, that is the firm's net income. And then for the other ratios, they're quite easy to understand, right? So EV basically refers to the firm's enterprise value. And then what you will do is you will calculate these valuation ratios for Idaco. And you will compare these valuation ratios with ratios obtained from other comparable firms. So here you can see that we have three comparable firms: Oakley, Luxottica, and we have Nike, right? So let's see how can we do the calculation here. For example, let's say we want to calculate PE ratio. Okay. And we know that P refers to the price of the firm's equity. E refers to the firm's earnings. So let's see what earnings we have here. So it's 6939. 6939. So I believe this number would be 21.6. Now let's see how can we calculate EV versus sales. Clearly, we need to first find out the firm's enterprise value. And we know that the firm's enterprise value equals equity plus net debt, right? So EV equals equity plus net debt. So you have to notice that the equity here I use is the price the firm wants to make the purchase, right? The acquisition price. So this serves as equity. And then net debt. What is net debt? It's really the firm's debt divided by, minus the firm's cash. So let's look at the firm's balance sheet and we see what is the firm's debt. You can see that the firm's debt is $4,500 $100,000. So it's $4.5 million. Now, what is the firm's cash? So, if you look at the balance sheet, then you have the cash here, which is $12.6 million. But you will not use this number because you cannot use all the $12.6 million because you have to leave some money to satisfy your working capital needs. So here the election note says you estimate that Idaho will only hold $6.5 million of cash in excess of its working capital needs. So here the cash amount is given by 6.5. And this will give you a enterprise value of $148 million. And now you can actually use this number divided by sales, and we can definitely get sales from the income statement, which is $75 million. So this would give us a number of almost 2. And of course you can find out these 2 ratios by yourself, right? Because you have you have EBITDA here, so it's very easy for you to calculate the ratio of EBITDA versus sales, or EV divided by EBITDA. Okay, after calculating these ratios, what you will want to do is to compare ratios, right? You can see that in terms of PE ratio, we have 3 firms, and I believe this is the average PE ratio. So you can see that average PE ratio is 20, and Idaho's PE ratio under the proposed price is 21.6. So you can see that it's in line with the industry average, right? And then for EV divided by sales, the sports good industry has a average of 1.4, and then the firm has a 2, so it's slightly higher. And then if you compare the 2.0 EV sales ratio with comparable firms, then you can see that it's higher than Nike, but it's lower than Luxottica, and it's the same as Oakley. So despite that, the fact EV sales ratio for Idaho is higher than sporting goods industry average, when comparing with comparable firms, it's still a reasonable ratio, right? It's still a reasonable number. And then if you look at EV EBITDA ratio, so it's actually lower than Nike, the lowest one among 3 comparable firms, and it's also even lower than the sporting goods industry average, right? And then you can see that this one. So the EBITDA sales ratio is 21.7%. And then you can see that it's actually higher than all these numbers. Okay. Now, let's dig deeper into these numbers. First, PE ratio. So, for PE ratio, if PE ratio is lower, then it means the price is more reasonable, or it's more likely that this investment is underpriced, right? So you can see that IDCO's PE ratio is in line with the sporting goods industry average, then you can see that at least when we use PE ratio, we can see that IDCO is not overvalued. And next, we look at these EV sales and EV EBITDA ratio. Again, lower the better. And in this case, you can see that still we can see that the IDCO is not overvalued. The last one is EBITDA divided by sales. This one is really a profitability measure. So in this case, you can see that you can basically consider EBITDA as profit. So here, if you have a higher EBITDA sales ratio, it means the firm has better, higher profitability. So in the IDCO's case, you can see that its EBITDA sales ratio is higher than all other firms, and it is higher than the sporting goods in the industry average. So basically, you can see that this is a good sign. That is, this firm has a very good profitability ratio. Okay, so overall, you can see that the acquisition price of $150 million is actually pretty reasonable, right? When compared with other comparable firms and the industry average. However, we know that when you're using valuation ratios, you're really only getting a ballpark estimation. So it will only give you the rough idea whether your acquisition is reasonable or not. So what we will do is we will formally analyze this acquisition. That is, we will think about or we will forecast the firm's cash flows, and then we will use the forecasted cash flow to calculate this firm's present value. Then this will give us a more rigorous idea on what is the value of the firm and on whether the purchase price of $150 million is reasonable or not. Okay, so first let's finish this example. So what range of acquisition prices for IDCO for PE, EV sales, EV EBITDA in the previous table? So here it basically says if you're having these ratios, what kind of price you can get from these ratios. So what's the idea here? Well, the idea works like this. Let's say you have PE ratio, right? And from the previous table, you can see that the lower range of PE ratios is 18 and the higher range is 28. Right? So now we have 18.2 and 28. And this means if PE ratio is 18.2 and earnings, we have saying that the earnings of the firm is given by $0.639 million. So if earnings is 6.939, then you can see that this implies the price, the acquisition price equals 18.2 times 6.936. So this will give us 126.3, right? So that's how you can get the number 126.3. And similarly, if you use a different number, that is, if you use the higher range, 28, then you will have 28 times earnings, which would give you a higher number, which is $194.3 million, right? So this number. Okay, now let's look at the ratio of EV sales ratio. So I'll just use this 1.4 number. In this case, EV equals 1.4 times the firm's sales. So what is the sales here? It's $75 million. Okay, what is the... Oops, I actually don't know what is 1.4 times 75. So let me try to use a calculator on my computer. So we have 1.5. And we have learned EV equals the price of equity plus net debt. And we know that the firm has the debt of 4.5 and its cash is 6.5. And then this means we can solve E here, which is 1.7. So this implies that the price of the equity would be 107, right? Again, you can do the same with other numbers. So you will have all these different numbers. So what you can see that depending on what kind of ratios you want to use, you will have the range of prices for the acquisition. And you can see that this 150 is sort of in the middle, right? So it's actually a fairly reasonable price, at least from the perspective of using valuation ratios. Okay, now let's talk about the more formal analysis. First, we will talk about the business plan here. The idea is like this. If you're a private equity firm, if you want to make an acquisition, you will not let the acquired firm just sit there, right? You will want to make changes. Maybe you will want to fire some people. Maybe you will want to divest some investment, right? Anyway, you will do something to try to improve this acquired firm. So here, the business plan is about how to improve this firm, right? It's important to think about this question because if you wanted to acquire this firm and you want to sell this firm after 5 years, then you will want to know what kind of investments you can make over the next 5 years to improve the acquired firm's performance. Then after 5 years, you can sell the firm at a higher price. Okay. Specifically, we will look at Idaco's operations and capital expenditures and working capital management and capital structure. And we will look at these different aspects and try to make improvements. So first, we will think about operational improvements. So you will cut some administrative costs immediately, and you will direct some resources to new product development, sales, and marketing. And after doing this, you will make some projections. So you believe Idaco can increase its market share from 10% to 15% over the next 5 years. And you will also think about capital expenditure. So you think that the increased sales demand can be met using the existing production lines, but only in the short term. In the long term, if the growth in volume is larger than 50%, then the firm, Idaco, will have to undertake some expansion to increase its manufacturing capability. So this is your projection or your assumption on IDACO's sales and operating cost. So you can see that first, you're assuming that the market increases by 5% per year, and then you assume that the market share of IDACO increases by 1% per year, and you assume every year the selling price will increase by 2%. And you will also make some assumption on COGS. So for the cost of goods sold, right? And what you see here is for the raw materials, you assume the price will increase by 1% per year. And then the labor cost will increase by 4% per year. And then for operating expense and tax data, for sales and marketing, and you will assume that the expense will be a percentage of the total sales. And then you can see that the sales and marketing costs increase every year because you're trying to improve sales and marketing to expand your market share. And then you will cut some administrative costs. And you can see that the share of admin cost declines from 18% in the first year to 13% in the last year. And you would assume that you will face a constant tax rate, which is always 35%. Okay, now let's think about the production capacity problem. So based on the data here, what kind of production capacity will IDACO require every year? When will the expansion be necessary? Remember that we discussed this. If the growth in volume is larger than 50%, then IDACO will have to undertake a major expansion to increase its production capacity. So basically, we will want to look at the firm's sales volume, right? And to get this number, we will want to look at both market size and market share. And using market size times market share, we will have sales volume, right? For example, the 2010, the sales would be 10,000 times the market share, 10%. So it's 1,000 units, right? So you can see that for 2010, we get this number. And for other 5 years, we could do the same. And then we will get all these numbers. And then we know that if the volume exceeds 50%, the firm will need to take a expansion, right? In this case, you can see that in the beginning, it's 1,000. So this basically means if the volume exceeds 1,500, then the firm will have to take some expansion. In this case, you can see that the expansion will start here, right? It will start in 2013. Okay. So this is the result. That is, in 2013, there will be a major expansion. And we assume the expansion will last for 2 years. So there will be large increase in capital expenditures in 2013 and 2014. And so you can see that here the firm Okay, first, these are just some given numbers, right? All these are just some given numbers. It basically says that, oops, God, oops, okay, sorry. Okay. So it says that the value of fixed assets at the beginning of 2010 is $50,000. And then the firm will make $5,000 of capital expenditure. And the depreciation would be $5,000 and $500. So the closing book value would be $49,500, right? And then you see that starting 2013, right? The firm will make major expansion. So the capex will be much larger. And then you can see that in 2014, we still have a higher level of capex. Okay, so that's for today's class.